While the, while the speaker is joining, should we start?
Yeah, we'll start. Okay, morning everybody, and welcome to this session on valuing startup companies. This is typically a topic which is of great interest to us because a lot of valuations done by smaller valuers tend to be of startup companies. And we like to have a situation where we are doing our valuations based upon the experience of others and based upon a certain theory and a background based on which we believe that the valuations that we give are realistic and justified. So it's a very useful topic for us to go through, regardless of how many times we do it. And I must thank Shilpa and Ravi for having organized these sessions because this is of use to us. While we wait for the speaker also to come on, I think Maneesh is on now, Shilpa. Okay,
Yes.
So I'll hand over to you then, Shilpa. Over to you.
Yeah. Good morning, everyone. It's my pleasure to introduce today's speaker, Mr. Maneesh Srivastava. He's a co-founder of Alpha Value Consulting and registered valuer with IBBI. He possesses work experience of more than 15 years with 9 years of merchant banking experience. Maneesh holds a strong foothold in investment banking, transaction advisory, and financial valuations. Maneesh specializes in mergers and amalgamations, financial valuations, due diligence, ESOP scheme implementation, etc. He is a registered valuer with IBBI, fellow member of ICSI, and MBA from IBS, and a PhD scholar. During his career, he has worked with organizations like PwC, PUG Securities, City Financials, Stockholding Corporation, before starting his own entrepreneurship journey of Alpha Value Consulting. Maneesh has acted as a speaker at various national and international forums, premier MBA institutes of India and abroad. He is also acting as mentor to various startups and also associated with various incubation centers like Atal Incubation Cell, Amity Incubation Cell, etc. Good morning, Mr. Maneesh. Over to you. And just a small announcement, you can please give a 5 minutes break at 8:30, Mr. Maneesh, so that we have few announcements to make.
At this time?
Around 8:30.
Okay.
And in the end, poll will be launched.
Very good morning to all of you. And I believe it's been too early for everyone. And so if you talk about people from North India, they generally rise at 8 o'clock in the morning, right? But it's good that you all have a habit like rising so early. And and we should learn from all of you, like how to rise so early. So today, yeah, good morning to everyone. So pleasure to be with you, and it's my gratitude towards BVA and to Abraham ji, Shilpa ji for organizing this session and inviting me. And the topic that we are discussing today, this topic, I would say there's nothing much of the thing that been written in the books. If you go to the books, most of the thing that been written is about how to value a matured company, what is methodology that being prescribed, and all those things being whenever the things are, the business is a settled business. But whenever we look into, talk into a startup, there being always being a debate, okay? And I've been really feeling a bit nervous, I would say, like to take this topic, because when the things are not crystallized, everybody has their own viewpoint, okay? And there may be certain qualitative factors. Some may agree, some may not agree with, right? So if somebody feels that the things need to be different, yes, I would not say that this is something what being a settled principle. We always try to look into or try to place our things in a way to reach to a certain visibility factor, that we are looking at something where what we perceive that this should be the case is. So the question is, like when I say startup valuation, the question, I don't have any of the background. And when I don't have a background, how to foresee the things forward? right? Somebody would say that, okay, there is a projection. Other one will debate why this projection, what is the validation of these projections are. One thing that is very important is what is the role of the valuer when he is doing the startup valuation. As a valuation professional, the question is whether I've been just going through what the management has represented to us, or is I being applying a certain validation and looking at whether what the management is projecting that is actually achievable or not. When you look into the real life world, the things are very complex. The question is like recently, like we carried one valuation in which one listed company has made investment. When we talk to the promoter says, sir, I can't provide you 5-year projection. This 5-year projection, I even can't perceive and see like what is going to be the 5-year rollout. Now, the management, the promoter himself not know what is going to be the next 5 year. And you are saying that, okay, I will do the evaluation and see that what is going to be the numbers. What to do then? And these are the complex issues that comes up. How at times there may be scenarios like when the promoter would say, sir, you make my numbers, you make my projections. As a valuer, I can just validate. The question is, I can't make your projections. I being not the promoter, I being not a person who being running your business. Okay. How can I say? I being not talking to customers, I being not talking to vendors, or I being not something actually knowing like how you will be placing your real business to the market, how you'll be able to attract or create attraction for yourself. Okay. So when this sort of things comes to you, then I would say whether I really doubt like whether we are doing the right job or not. So the question we need to address is we need to ask as many questions from the promoter as we can, so that at least we should have an idea like what it is into. Even if suppose 5-year projection not provided, only 3 years projection provided, then what sort of scenario we look at and roll out the future another 2 years plan. Okay. But frankly speaking, I would again suggest that it is not the role of the valuer to make the projection. I can make a projection for myself in order to look at whether this projection should be achievable or not. This should be the right projection. But I can't say to the management, this is your projection, what it needs to be, right? So these are the complex things that generally happen. And another important aspect, which I want to highlight over here, ask to yourself whether we are doing the real valuation or we are just deciphering the price, the transaction already decided, price already fixed, and they are saying that, sir, please make the valuation report. The allotment price will going to be 3,000 rupees per share. Now this 3,000, what I've been doing, I've been just doing the backward calculation, trying to place the numbers in a way, trying to fix the additional risk premium, try to look into like how the projection can be tweaked a little bit and this thing, that thing. That is actually a reality, right? That we need to accept it, that we are not doing the real valuation in that balance because we are not deciphering the real value. Something being told to us and we are started doing the backward calculation and just reaching the numbers, that this is going to be the real numbers and this is how the value being derived. The question is, because I need to file this certificate before the regulatory authority, before the ROC, and they will say, okay, the per share value, there's nothing to do. They say per share value coming 3,000, allotment is taking place 3,000, and that is all. Okay. But I would say this is not a real valuation. The real valuation is when somebody comes and asks to you, sir, this is my product, these are my services. Tell me, and this is going my future forward projection, what I perceive. Please tell me what should be the fair value based on this. Now you don't know the price, suppose. You are finding the price. At what is the price? It may be 3,000, 5,000 or 5 lakh rupees per share. Now you are doing the real valuation. So at most of the time people say like we are doing the valuation. We are not doing valuation, we are doing the calculation. When we are just arriving at the price that being told to us. And in case of a startup, generally the thing goes like this. I being not being sitting in the fund house, that I being making investment and looking at what should be the value of this company. We are sitting a more like a registered valuer, and the things that comes to us that, sir, this already price decided and you do this valuation. And then we try to look in how it needs to be done. Okay. But when we say business valuation actually talks about real value. Then you will start, because everybody wants to find the harbor, like which will provide me a certain support. A valuer always thinks like, what should be in the mind of the promoter? What should be the value is? If I suppose provide these numbers, this value, whether the promoter will think this is correct, or they will just say that, sir, what you are doing, you are just talking about 50% value, what we are thinking. Okay. So it's difficult. But the question is, if we able to sanitize the business model, if we able to understand the business model more, instead of just going into the projection and saying that this is based on projection, the value is this. Before the projection comes what? Before the projections comes the integrated business model. Like if I've been saying in the year 2022, the value of the turnover top line is going to be this much. From where these top line number that is coming from? What is the per unit thing, and how these numbers been built upon? What is the number of the customers that you need to capture, and how you have built these numbers? If these things are clear, then only we can say that we are actually doing the valuation. If just we are providing template, they are filling the hard punching the numbers, and we're doing the valuation, that is not a valuation at all. There being the discussion in one of the forum with Mr. Damodran, and the question being asked, like the projection being provided by the management, and we do the valuation based on the projection provided by the management. He has a very different viewpoint. He said that why you are doing the valuation based on the projection provided by the management. You need to look into, you need to make your own projections, and then you say that this should be the value of. Then you are the real valuers at time. But the question is, we are not Damodran. The question is, we have the time constraint as well. We have to run, we being into the commercial world as well. So we need to, the question is, before moving into the projection, we just need to understand more into the business model and the business sense, what it's going to be. What is the driving factor? What is the cash flow ability generation of the company is? Whether that free cash flow is coming in at least like 3 or 4 years down the line. At times there have been certain scenario in which the company has projected 5-year projections, and what is happening even in the 5th year, the company is into the negative cash flow zone. How to do the valuation then? If I apply the terminal after the 5th year, which is again negative, the negative value will come. I can't derive the positive value out of that. So these are the complex issues that been there, and this been the real challenge that we need to address, we need to fight. And so I would say, like, before moving or rolling about for any startup valuation, Okay, when I say startup valuation, I'm not talking about like I've been doing the backward calculation and finding the number. That's the management has told. Okay, I've been talking about a real. Suppose somebody comes to you and says, please find the value of my company. What should be the fair value of this? In that balance I've been talking about, we need to first understand basically the industry, first the economy, then the industry, and then the company. Because understanding the industry automatically provides us the insight, like how and what is going to be the, like I can look into like what is the profit margin in this particular industry need to be. The company is projecting something, I can, like at the initial year, the profit margin may be very different because the company is not crystallized, the things are not structured, and you may have a very strong future profit margin in maybe 1 year or 2 years. But in the time to come, as you scales up, automatically everything syncs to the industry, everything syncs according to the market dynamics. Okay, suppose if I completed my chartered accountancy and then I started my practice, I have a one room only, and in one room only I started my office. I have no employee. Suppose if I earn 2 lakh rupees in a month, I would say entire 2 lakh rupees in a profit, no cost, no employee cost, nothing, no office cost, no rent, nothing. But when you go your practice in a bigger way, and then the employees start adding office rent, everything, then of course my profit margin start tumbling down, and it finally reach to the level where the industry actually is. Okay, so I can't run out of the industry. So industry understanding is one of the very important ingredient. Another is, a lot of time certain segment comes to you which we have never valued, and those segments are very new segments. Okay, when these segments are so new, we don't have even like the visibility, or we don't have the comparable company to look at, like how this industry actually works. What to do then? There may be like, I don't have the comparable company, but there may be the situation, the industry exists. Then I need to look at the industry. Another important aspect is, suppose comparable company, listed comparable company not existing, no problem. I will look into what? I will look into the unlisted company, which are bigger companies in my segment, which have already secured funding A, B, C, D level. And now I will look into what should, I will go to the Ministry of Corporate Affairs, download their balance sheets, look into like what is the profit margin that they had when they get the first level of funding. What is the path they have traveled? Okay, because everybody start comparing himself with other company, which is a bigger company, which again is a private limited company, but start comparing at a different stage. I being at a 0 stage, that company is at a different stage. I can't compare myself with that company because these are the 2 different stages. If I need to compare, I need to compare with the very first funding that has happened in that particular company. What was his first particular year or the second particular year? Then only we can look into like what is the correct, basically the margins, or you can see correct indicators which will lead us to the correct valuation. Okay, let me share a screen. Is the screen is visible?
Yes.
So generally, when we talk about valuation process, today in this session, I will try to cover 3 as important aspects, like venture capitalist method, and try to do it over the Excel as well, like how it need to be done. Okay, the scorecard method, the venture capitalist method, and the Chicago method. We try to look at a glimpse of like how it need to be done. So I will cover later into this session.
You can make it presentation mode for the PPT.
is that presentation mode, but slideshow.
Slideshow, yeah.
But like why it is not? Is it now?
Yes.
Okay. So when I say valuation process, the question is like we need to look into like this is the way that we take the thing forward, that we collect the data, review the document, signing letter of engagement, understanding the assignment, research as per CIE framework, submitting the report, valuation analysis, sharing and discussion on the draft working with client. At times, what is happening, like people make the valuation, they prepare the report and then submit it to the client, and the client says, no, this is not right. Or any discussion that needed to be made, upfront before starting the valuation exercise. Because once we are through with and then we are going with the discussion, then end round of discussion will happen and again we'll be burning our fingers. So discussion should be the first point, and that is a very important point in the valuation process. Okay. Challenges with the value, I already told you, like no historical background, no comparable companies, not much future visibility. These are the landscape under which we are working, and these are the challenges which are always being there. Now, when I say business model, this is the important thing that needed to be understood before going into the projection of the company. That is key component business model include relating to our target customers. Like what are your target customer? What is the geography in which you are talking about? You started a business in suppose in New Delhi. In New Delhi, you will see that what is the traction first, then you will go to the NCR region and then you go to the other geographies, right? The market, the organization strength, challenges, essential element of the product, how your product and service are financed and how it will be sold. There being a lot of debate with regard to the intellectual property as well. What is happening? People are saying that, sir, I have filed a patent. There is a gap between filing the patent and actually the patent being granted to you. Okay. So there's a difference in the value proposition. I can go and file the patent, but the question is whether I will get the patent or not. That is again a question point. So there may be three types of companies. One company which has no patent, another company which has filed the patent, and the third company which has actually received the patent, which means the patent being granted by the patent office. Okay. So IP also plays an important role when we say valuation, while doing the startup valuation. Somebody was saying that, sir, my company has got the patent, and can I book this patent in my books of account? Can I assign value to my patent to my books of account? The question is like, whenever you have created something on your own, any intangible that you have created on your own, you can't book it in your books of account. But whenever there's been an inorganic, that you are saying that I have acquired that particular patent or trademark or any intangible, then of course the person who is acquiring, the company who is acquiring can book it in the books of account. Okay. So whenever there's an inorganic thing, you can place it in because you have paid the acquisition cost, and the consideration, you are bifurcating that out of the consideration that being paid. These are the classification of the fixed of the tangible assets, the various sort of the intangible assets, and that is how we are saying that this is the value proposition. So another aspect is I have taken the patent, but suppose the patent which I have taken is not in consonance with the assets what I possess. Okay, then I may not be able to create a commercial value out of that patent. So that is also important aspect, whether you have worked something, you got a patent registered, whether that has a commercial value or not, that is maybe the question point that is there. Okay. So somebody says like, I have just applied for the patent. Do it has a value or not? I would say it has a certain amount of value, because before going and making an application for the patent, there are certain processes that you need to follow. You need to define certain things. And in defining those certain things, you structured your organization well. So when you structure your organization, of course, the value is being created for your organization. Okay. When the promoters start the business, the promoter is required to do a lot of research in order to say that whether the thing that I've been starting is will actually lead or bring some fruit or not. And that is similarly the role of the valuer. The valuer also has to do a lot of research, look into various segments, understand the segment better. Then he will be in a position to demonstrate and say that this is what this is how the valuation of your company should be. This is what I understand about your industry. Okay, that will then you will be more in value addition you're able to place to any organization for which you have value, because you understand the dynamics of the model. Okay. I will not go through this slide. This is basically talking about more like what are the fundamental methodology, income, asset, and market. These are the main like methodology which generally being used when we value the companies for matured companies majorly. I can't apply an asset-based method for a startup. I can't apply market-based method, comparable company, because as on date, the company has no revenue. It may suppose having no, it may have a revenue, it may have a no EBITDA or negative EBITDA or negative profitability. I can't apply any multiple to that. Then I say that these valuation approaches are more relevant when you talk about the matured companies. Okay. This curve I want to place a little bit of emphasis. The reason being, suppose a startup comes to you and they provide you 5-year projection. In the initial 3 years, the company is into losses. 4th year, extraordinary profit. 5th year, supernormal profit that being represented over there. If I apply the Gordon model after the 5th year, I may not be doing the correct job. The reason being, because I have not captured the growth phase of the company. I have just stopped. The company was growing at a level of 36%, and I have just synced it in the 6th year, maybe then the terminal year, and saying that it will finally culminate to 4% terminal growth rate. So I have not allowed the company to grow and not able to harness or capture the real growth of the company. So what I would suggest, like whenever we do valuation of a startup, we should apply an H model. That is a 2-stage model. After the 5th year, if there is an extraordinary growth, then we say that for another 3 years, 4 years down the line, they're going to be a high growth period. And for that, there will be 2-stage model we are applying. And for this, another 4 years means saying that this is the value as per the, again, applying the Gordon model for this number of years, and then saying that after this another 4 years, then the value will culminate to 5% terminal growth. Then it will be a better presentation, and then we're able to capture the real growth of the company. So please.
Mr. Maneesh, sorry to interrupt you. You are trying to say that Gordon growth model will be applied for initially high growth period,
Yes.
And then a terminal growth rate will be taken,
Yes.
right? We have a separate H formula for that.
Yes. Suppose if I say that in the 5th year, the suppose the you are saying the percentage is like it is growing, the company is growing at 36%. Suppose, then I would say like maybe for another like period 3-4 years, it may be growing at a level of suppose 20%. I can't bring from 36% directly to 4%. I need to look at a high growth model and look at like H model basically, and look at that this is, it should first go to at least 20% level, and then it should culminate. So then we'll able to find that high growth period and find the real value of the company. Otherwise, we are not doing the justified job, because like when you go to the books, they just say that apply the Gordon model of the 5 years. That 5 years is basically the period when we say matured company, when my profit margin, everything is in sync with the industry. And then we say that, okay, it will continue forever. When I ask a question, after 5 years, why? In a matured company also, after 5 years, why? Because we see that in the 4th year and the 5th year, what is happening? It is again like the margin is suppose 14% and then it is committing to 13%. I've been saying, okay, it has become more structured. The company has reached to the more of a maturity phase. Then, okay, that is fine. So that may be good for a matured company. But for a company is a startup, it may be like 300% growth, maybe in the first year, 200% growth another year. So I need to provide a certain amount of, management can't provide you a projection for the 7-year, 8-year. It can maximum provide you 5-year. Okay. You can apply an H model and can take it further 4 years. There is no need of doing the entire, like, what is the profit, like entire rolling out the entire like 6th year or 7th year or 8th year, but you can apply the H model and find like what should be the value based on this. Okay. Okay. Should I move further?
Yes, yes.
So I will come into the Excel in which I will try to explain like how the things needed to be done and what is the way forward to look at for the startup. So before going into that, I will place just little bit emphasis on the scorecard. When I say scorecard, a scorecard is basically the grade card which talks about the qualitative factors about your company. Okay. You can build n number of the scorecard. This is not the static scorecard, what I've been presenting. You can place it like 50 points and you can say that this is the scorecard. And for every company, based on the industry, the scorecard will differ also. The certain points will differ, right? The question is like, when I say score, when I say this being the all qualitative factors, which I'm not able to address in the financial number terms. Okay. So I tried to look into like, okay, these are the qualitative factor. I should assign certain weightage. I should assign certain probability factors. And based on that, I should assign certain weight and find like what is the score that is coming for these companies. Suppose if we start a business today, and suppose Mr. Sundar Pichari start the business today, some new business, some new thing out of Google, he start doing something. The value proposition that the startup that will hold will be very different because he is a person of name, fame. Everybody knows, people know that he knows the in and out, well connected to the investor. The very first day, what will be happening? There will be the line of the investors that will be there. Okay, Sundar Pichari is doing something. Okay, he can build up the $1 billion company. But if you or I started something, it may be we need to go to the end number of the investors, talk to the venture capitalists, and then only the thing will finally settle. Okay, so these are the important things. Like what is the profile of the promoter? That is very important aspect whenever we do the valuation of the startup. What is the credential of that particular person is? Suppose he's saying that I've been starting to do something which I have never done in my life. I've been into a job, I was working in a bank, and now I've been starting some e-commerce company. There's no correlation between the two that exists. So that correlation also need to be looked at. Suppose this person has funds, he has money, he has saved the money, and he is placing the money, and he is bringing the co-founder along with him. And the co-founder is a person who being a seasoned person in that particular industry. Then we would say, of course, okay, now this combination is making the things better. The person has certain, he knows the in and out about the industry, who is the co-founder that is coming. Then we will say that, okay, this company will do well, because the promoter co-founder knows the things better. Then we need to look into the team size. What is the team size is? What is the capability? Because when I say team brings about the capability factor. Suppose somebody says like, you have your office, who are the person working under you? That may be the very basic question that being asked. Suppose you say, I being a valuer and the person who are working under me are just being CA interns or CS interns. Now the question is, they are just interns. They don't know how to do it. And something comes to you and you delegate it. You do this thing, I will review it. Okay. I'm not saying I'm not against like whether interns should do or not. The question is like, even if they are doing it, you need to train them first, make them aware about like how the things work, and then only you will be in a better position to equip the things together. Okay. So when I say team plays a very strong role in creating the value proposition. People come to the business part later. People look at the promoter's profile, team profile, these things. Then another aspect is technology. The things that you are talking about is something like more on the technology side or not, or just being a raw thing that I've been, they being one like a startup which came to me. He's saying that we make like samosa and chaat, and this samosa and chaat, we have a shop, and then we'll go and tie up with Zomato, and then this thing, that thing. I was just thinking, like, what is the technology behind that? There's nothing like a technology factor. You are making the samosa, and you may be one of the best maker of it. Okay, but so this thing need to be addressed and looked at. Suppose you look at a product profile of Chayos. Chayos is also making tea. Now it has started making samosa and all these things. But they have created a certain amount of technology factor behind it. If you are sitting in your office, you ordered a tea from Chayos, they have developed a container which will make the tea hot for at least 1 hour. That will be super hot for 1 hour. So that is something that they have created and they have built into the system, and that is how they're able to scale based upon their technology factor. Because tea is something you can't transport it; it will get cold in just like 10 minutes time. So we need to look at what is the technology involvement that been there. Okay, so I'm not saying that this is the scorecard. This is few of the factors of the scorecard. Okay, you can build a number of like whether the company has patent or not, trademark registered or not. So a number of things you can build upon and say that the scorecard is like that. Okay. So the very first method I would place is the venture capitalist method. And venture capitalist.
Maneesh, sorry to disturb you. This scorecard methodology, what just now till now you have shared with us, is this a part of your working papers, or you're going to put same whatever you're showing to us now, or the summary in your valuation report? What is the final thing which you have opted or which you feel is better?
When you're taking the valuation report, you're talking about something that needed to be filed with the registrar of company?
Yes, like what you actually issue, like say 10 page, 15 page, 20 page reports, okay. What I issue.
Okay.
Is this a part of that or working paper, or just a summary of this will come?
I tell you that this is a good question, that there's a lot of confusion over this, like whether what being presented in the report. Okay. The question is like, under the Companies Act, what being defined is you need to do the valuation as per internationally accepted valuation methodology. The question that you are raising is similar to me as well. I don't know if I place these things together, whether the ministry ROC will look at and say that, okay, this is fine, because they are the person who are more versed to look at the discounted free cash flow and say that, okay, this is the value as per DCF. Okay. There is a difference between what we do in a regulatory valuation exercise and what we do in a real business valuation exercise. So when I'm talking about these methods, we look at all those things whenever the investor is saying, please value my company and please value my portfolio company, or the promoter is saying, please value my company, I don't know the value of my company. So this is the real valuation that is there. But when finally the things will finally settle and it will be said that, okay, based on these, everything that being discussion and number of discussion, the value should be suppose 3,000. Then again, that backward calculation, or you can say discounted free cash flow, and say that this is the value that being there. So this thing we will present, because we being also being part of the various, like the venture capitalist, we being associated with, and they being asking us for the valuation of the company. And then we are doing all these things because they understand all these things, right? But when you go and so to the Ministry of Corporate Affairs, even suppose they give a call to me, or the income tax authority give a call to me, I will take about like 10 days time to make them explain like what is there, how you looked at and all these things, right? Because they don't go into the nitty-gritties. They say that you provide me per share value. Even they don't go into your DCF. They say 3,000, okay, that is the price that is there. I'm not criticizing the ROC because they have their limited way of looking at the things. It is because valuation is a commercial call and you have finally settled at the commercial, and then only you coming to the ROC for filing the allotment shares, right? But I would say if you want to be into a real valuation game, then you need to understand all these aspects, okay? Then only you can talk to the promoter and say that I can find a value for you. Because they are people who have built the businesses who are doing good, who have, I being also part of that ISB, Atal Incubation Cell is also there in ISB, Hyderabad, and I being a mentor to them as well. And so now they've been very bright people who have been sitting over there, and they know how to get the things done. But if you start talking like 5-year projection, this is that yaar kya baat kar rahe ho? You ask me relevant question, na? So these things are the points which will make you address before those people and make them aware about how the real valuation need to be done, okay? So this is nothing to go with the registrar of companies, I would say. And if you want to try, you can try in your valuation report and place it before the registrar of company and see like what is their repercussions are. But if that able to sail through, I've never tried. Personally, I never tried for filing it with the ROC. And if they say that okay, that is fine, then everybody will start doing the things together. Okay. But again, like because we don't have to do the valuation, we need to find the price, and finding the price DCF works very well. That is a magical game, and everybody does it. So, and but we are here more on a learning curve rather than just like, because everybody know how to do the DCF, finding the value as per DCF and placing the report. IBBI number, this is my IBBI number, and this is my ROPO number, and this is the report of, and these are the caveats, and this is what is there. But we have to be above of that in order to reach to the level, in order to understand more of the things. Okay. So this is now.
Before we continue, I just had, when I'm doing valuation under some 4 or 5 different methods or 3 different methods, I give assign value, weightage for each method in this scorecard or venture capital method, and this goes to ROC. So I think I'm going to put everything in the valuation report, not only the DCF.
Yes, if suppose you are doing this way, and you can, I've been saying that you can place it. Nobody is stopping you to do it, so because it's being said that as per internationally accepted valuation methodology, and that is internationally accepted, that these are Chicago method everywhere, that being written Chicago method is Chicago method. And but whether the ROC will able to understand, I able to, because everybody is in a hurry that I have to make the allotment. If suppose the object, I tell you that we've been registering one LLP, and for as a registered valued entity, and for that the agreement letter being signed, and there's a form called Form 3 that needed to be filed with the ROC. Now what is happening? Already 25 days passed. We are not getting any revert. After 25 days, one revert came, and they said that you have placed the stamp paper of 100 rupees, and that is 750 rupees stamp paper that we need. We made again 750 rupees stamp paper. Now what is happening? That you are just like spending your time, effort and energy. So we need to look at किसको क्या समझ में आता है, उसको वही चीज समझाएगी जिसको समझ में जो आता है. But when you go to talk to the investor, when you talk to the promoter, then this is the exercise that needed to be done. आप उसमें hard punch number you can't place it. Somebody investor will ask to you, these numbers being derived from where? How you have built upon these numbers? You need to understand the model and all these things. Okay. So if I say 100% correlation between what I've been saying and what the valuation report will be, I would say that not like 100% correlation that exists. Okay. But real sense, real value, how to derive that value when you don't know the price, then these are the factors that you will apply and look at. Okay. I have already said that I was very afraid to take this session because this there have been always being a debate, and I've been the question that comes to your mind, it also comes to my mind. Everybody, we all being in the same plane, right? The plane is supposed from starting from Afghan, and everybody wishes to like take this plane and take an exit from there. I'm not in a different plane. So venture capitalist method, suppose this method is basically, you can say, a shortcut method. The shortcut method in a way, like, and this is the investor method basically, that when the venture capitalists look at a thing, how they place the things together. They look into like, they say that, okay, suppose if I am willing to make $1 million investment in your company, okay? And they say that the return expectation, what I have, internal rate of return is 25%. And I will make investment for 5 years and I will take exit after 5 years. So these are the defining terms, like when they are going to make investment of $1 million. And they are saying that as on date, suppose your company revenue is $0.5 million. What is going to be your 5-year, forward 5-year revenue? Suppose you said that I will be able to achieve, on a conservative basis, you said I will be able to achieve $1.5 million. Okay. What is the expectation when I take an exit as an investor? I've been saying that I will take an exit at least a 10x multiple. Okay. So these are the defined terms that being already being there. Now, based on these terms, I've been saying that for $1 million investment, what is the stake dilution that need to be made? Then how to do it? So when I say required future value of investment is equals to $1 million investment, growth rate 25%, 1 plus 25% at a power of 5 years, that is $3.05 million is the required future value of the investment. Okay. Now at that point, the company is expected to be worth. Exit value is already defined by the investor. It says that 10x multiple I want. $1.5 million is the revenue in the 5th year. So 1.5 into 10, $15 million is the exit that being there. Venture capitalists must own how much now? For this $1 million investment, and with these factors in place, 3.05, that is the required future value of investment, divided by $15 million equals to 20.3. So if these being the terms, then the dilution that will need to take place, 20.3%, that is the stake dilution. So this is a quick way, and every venture capitalist have in mind this thing, that, okay, boss, suppose if I make $1 million, I need 20% of your company. So हम लोगों को लगता है ना कि कैसे वो 15 और 20% की बात क्यों करता है, 10% की बात क्यों नहीं करता है, क्योंकि ये जनरल टर्म्स है, क्योंकि वो प्रिज्यूम करता है कि दिस इज हाउ आई विल लुक एट. एक important aspect बताते हैं, there being a difference between venture capitalist and private equity. Venture capitalist का core focus क्या है? The core focus is, sir, increase the top line. He is not being looking into your bottom line. Traction, top line, very impatient guys they are. You just being focused on the top line, and because they want to take an exit, not when the company will get into the profit zone, but at a time when the traction will be there and another investor, the private equity guy will come, I will take an exit, because they don't want to like look into going to the IPO level. They will take an exit, place the money in some other small company. They play a very shrewd game in a way that they say, okay, suppose a company is looking for fund, there's a dearth of fund in the company, I will place 2 crores of rupees, take 15% stake of your company, and the company has to nothing to do it. They have to, because they have to. There's a working capital problem. There's a cash crunch. All these things being there, so they take it, and that is where they take a high stake into a company at a very initial level. Okay. So this is basically the venture capitalist. Let me come to the Excel part. Is the screen visible?
Yes.
So this being one of the case study, and this is not something that being a created study. That is something which is the real life that we have carried it out. Okay, and that is where the funding has also happened. So because this Shilpa has raised a question and Ravindraji has raised a question whether that being really being the part of the valuation report. I would say not to the for the ROC purpose, but for the real valuation purpose, yes. These are the things that needed to be looked at. Okay, so this being the case study in which, though of course like few dates that being placed differently. This being about 2 years back, this exercise was taken, but certain things that been changed because I can't present the real thing about the because of the confidentiality factor. Okay, so as on the valuation date 31st March 2021, company X has not started generating revenue and is currently operating at a loss. So the company's just started, is into a loss, and the company has skilled co-founders. The promoters and the co-founders, they being the IT guys, and they know all the technology factor and all these things. And this being basically the software application they have developed for the bus and the stations, bus stations. So suppose somebody wants to go on a long from interstate with a bus, then there being certain like Wi-Fi arrangement is there. You can look at in the bus only because there is a network issue and the bus is moving. So they have developed the thing that there may be certain entertainment programs that will be there. There will be a lot of like movies, theater things, a lot of the stuffs that they have. So they said that I will place it in a bus, and then the people can subscribe it at a very minimum cost, and then that is the revenue model they have placed it. Okay, so this is what they've been doing it. X has also acquired several customers and expected to generate revenue in financial year ended 2021. They are saying that as on date we are not being creating revenue, but in the time to come we'll be creating the revenue. So don't go with the dates because like FY21 that has already happened. So I've been saying, suppose we are sitting today, they have taken certain customers on their roll, and they placed the software in few of the buses, and now they are looking at rolling out in the entire segment, and they are looking for seeking funding of $1 million. Okay. Now, this is the real business valuation that we need to do. We not need to arrive at a value proposition. So what we have asked for them, the very first question, sir, you provide me your assumption sheet, first of all. And under the assumption sheet, you also provide me a 3 stages, like suppose everything goes in a way that you think about, what is the most optimistic way? Suppose something goes on an average, the things what you are thinking that does not go in that particular way on an average basis, and something suppose fails, and then what it's going to be. This person was very technical guy, so he able to provide us these particular 3 scenarios. There may be a situation where the promoter may not be able to provide you. They will provide you just one optimistic projections, optimistic model. So then we need to make that particular business model for my average and my pessimistic scenario. Okay. So now look at here. So now what being there year 1, year 2, year 3, moderated yearly revenue per bus. What he's saying is $1.53 million rupees. That is per bus. Year 2 1.60 and year 3 1.72. Moderated yearly revenue per station, because that software is also in a station. People are standing in a station and they're waiting for the bus. They're being a long waiting time as well. So that may be the revenue stream that will be there. So it has defined that the number of buses, that is 175, number of station that there was in talk with is 5, technology cost per. So this is the assumption sheet. So what I've been earlier saying, that just hardcore punch numbers, that does not work. You need to understand from where these numbers are flowing. So this is the assumption from where these things will flow, like how my cost expenses that being built, how my profit that being built. So these are actually the real picture behind that. The manpower cost for buses, then license fees, internet cost. So all these things are being the assumption. I will not go into detail, but this is how it's actually being undertaken and assumption being provided by. So based on these assumption sheet, if I look into revenue from the buses in the year 2022, and that is how we are, this is now not 45.81 is not a hard punch number. This is the value that being derived based on the assumption that he is providing, that what is going to be the number of buses and what is the revenue per bus. So this is how we are saying that this is the revenue that being built based on that model basically. Similar way, the expenditure that being built, like manpower cost, internet cost, so all these things that being ordered, total expenditure that being built. And this is now the profit after tax that being there. Okay. So this being the most optimistic view. Then we look into like what is the average view. Here the number of buses that will go on a lesser side. We'll say an average of that. And then we'll say that this is, the third is like the low growth scenario. Okay. So this being the 3 scenarios that needed to be built at. So when I say first Chicago generally talks about the scenario analysis. It talks about what are the 3 scenarios under which this model will be workable. Okay. Now the question is, I can apply a discounted free cash flow on all these 3 segments, all these 3 scenarios, high, low, and medium. I can apply a multiple as well. Okay. I would say that maybe in the current year, there is no revenue, but the next year I need to look at, and what is the next year is, based on the next year, I can look into what should be the value, because for a startup, I can't go and apply the 5th year and say that this is the value will comes in like something extraordinary. So what I looked at, like projected sales of the company, these are the 3 scenarios: success, survival, and that pessimistic view. Projected sales of the company for the year ended 2022, 199. It has reduced to 132 in the survival because my number of buses being lowered down, tuned down. And again, so this is how, and the full year was 74.04. Projected EBITDA of the company, 127.95, based on 3 scenarios, 85.30, 47.82. Then I've been looking into the present value factor, and the present value factor. Now, under the present value factor, I have to go with the cost of equity CAPM model. But under the CAPM model, because it being a startup, I need to fix an additional risk premium. Now come over here. A success case, risk-free rate will remain the same under all the 3 scenarios. Sunset's return will remain the same under all the 3 scenarios. Market rate of return remain the same. Industry beta will remain the same. Only thing that will be different is the additional risk premium, that is unsystematic risk. And that is 8%. We are saying that when optimistic scenario will be. then when you are saying high growth, everything being on a super super normal way, then we are saying 8%. Now, when I go to the survival mode, I have made this additional risk premium go on a lower side to 7%. Okay. It all depends upon how you are looking at the business model. If somebody will say like, why 7%, why not 6%? That may be the debate, but you need to look at like how I need to look at what is the overall cost of the equity. In the earlier case, 23.32, in this case, 22.32. And similarly, in the failure case, it is 21.32. I was just looking at bringing the cost of equity by 1%, 1.5% down in every scenario. Okay, that is a prime factor behind that. So now, based on this, the cost of equity that what we have calculated, that is a present value factor that is coming 0.90. You will see that 0.90, 0.90 same, but it is not same because if you go to a decimal place, that will change, right? Because it is just 2 decimal place that being reflecting the same thing. And then 0.91. Adjusted EBITDA we have derived out of that. And then we are seeing industry average multiple. Based on the industry multiple, we find that 4 is the multiple. Based on the industry to industry, you're able to find like what is the industry multiple is. Enterprise value of the company, 460.89, 308.5 to 173.6. So this is what being provided by the management. These are the 3 level: high growth, everything optimistic, something on a normal thing, or then on a pessimistic view. But I would say that these are 3 scenarios basically. But what should be the probability factor for these scenarios? Because the company at the end will not go in all the 3 scenarios. It cannot be a failure as well as a success. So there should be some probability factor to that. So I've been saying like 50% is the probability for the survival, I've been saying. And on the 2 extremes, I placed 25%, 25%. This percentages may vary based upon your understanding about the company. I am not saying that this is a fixed rule of applying 50, 25, 25. So based on this probability factor, I've been saying that the value of the operation is coming close to 312.89. Okay. Then because this is my enterprise value, I've been adding the cash, deducting the debt as on date, and finding the concluded equity value. But this concluded equity value is the post money value. The reason being because this thing I able to achieve because I have got a funding of $1 million. So I've been saying that this are all the achievable number after infusion of the $1 million. So so this, when you look into the row number 14, that is estimated capex required, this 75 is basically $1 million into 75 is the rupee. So 75 that I've just converted into rupee terms because I initially said that $1 million is the investment that will take. So this 75 I've been deducting, and I've been reaching at a pre-money value of 218.77. So my concluded pre-money value in USD term will be 2.92. So this is the way like how to reach at a particular value based on various scenario, and after then assigning the probability factor to the various scenarios. And this is how the first Chicago methodology generally works. Okay.
Can I ask a question?
Yeah, sure.
You are already discounting it to today's terms, the value of all the projections. And then again, you are subtracting the capital that has been infused. So this capital, you are infusing entire capital in today's terms, the 75?
This capex, that is the amount that being infusing it at a very first day, 0 day, that the company is saying that I being a startup, I have no revenue as on date, and I need at least $1 million funding. If you provide me $1 million funding, then my company will go this way. So actually the company is taking this money, and then only this actually thing is either I have my own company, own pocket, I am not taking the money from somebody else, then I would say there was nothing like a capex that will be there, that this infusion is not there. Then this is based on my organic thing. But because I have the cost inbuilt, because I have taken the money from somebody else, so this I've been saying that this numbers are achievable because that this is something that the money infusion will take place because on that. So that's what I've been saying, that this is the post money value, that what we have found it, and now we are coming to the level of the pre money value. Okay.
Thank you.
Now,
Sir, may I ask one question, sir?
yes, please.
Sir, in this case, like, generally what we find that when we take a projection of 5-year or let's suppose a 10-year, so there will be, the projections are based on like, on the
one
future.
thing. I wish to see your face once.
Sorry.
Because like talking to somebody on a dummy is very difficult.
No, I'm so sorry. Yeah, hi. So so my question is like, when we take a projections or we do the deliberation on the projection, so the growth is expected not on just the capital infused on the valuation date, based on the valuation date, but like, over a period after say 3 years, there will be more capital infusion required based to achieve that numbers. So when we take a projection for 5-year or 10-year, so do we take projection based only on the capital infused based on the valuation date, or can we assume further capital in the future period also?
This being a very good question, and a lot of confusion is always been there on this part, because like infusion will take place at different point of time. It may be in the year 2024, the infusion will certainly take place, then it will go in 2027. So I should capture all the infusion and say that this, based on these infusion, my value is this. Okay. The question is, I being doing the valuation as on date basis. Okay. If suppose for a minute, I go with the way that what you are saying, suppose we are saying that we will take all the infusions. Okay. Then across like the cycle of the company, there is no need of any valuation, because every infusion is already being countered in the very first go. And then I will not say that after 1 year, 2 year, because that is something that is what is already have happened. And that is how we are already factored something. And now whenever we are doing the DCF valuation, the inflow and the outflow of the equity is not being taken. That is not the part of my DCF valuation. Okay. So the question is like, I being doing the valuation as on date basis, what is the infusion that's being happening? I will talk about today terms only. Maybe what is going to be the future, that is not something we will look at into my inflow and outflow. When that point will come, suppose we are standing in year 2024, and again this infusion is taking place. At that point of time, we will look into what is the inflow and outflow and what is the impact on that. Suppose we again go to 2027. That is why every times the infusion of the funds take place and there's an allotment of shares take place, the person comes to us and say, please value my company again. Okay. So that is the answer to this question.
So that means like, so do we actually control the growth factor, like, based on the existing capital, or, my question still, I'm not very clear on the explanation. So basically what I meant was, say, let's suppose in today's term, we are saying that we are getting an $1 million capital. And based on that, the company is able to achieve a growth of X percentage over a period of 10 years. But like, that percentage of X percentage is based on not just 1 million today, but like, after 3 years, 2 million further infusion and 5 million further infusion at a later stage. So there are two options available to me. One is like, I say to the client that I will not take this much of growth because this is based on the future capital infusion. So I will reduce the growth only based on the capital available to you right now, and I will assume only the growth which is possible based on the current financials, the funding available to you. Or I will accept that growth pattern, and I will calculate again the present value of that capital and minus in this particular column, and arrive at a pre-money valuation. So I am not very clear on that, sir.
So the question is, sir, I will ask one question. Like when we say, like, suppose we find the enterprise value.
Right.
From the enterprise value, we need to deduct the debt. Okay.
Right.
Suppose my company is raising debts in the future year also, not
Right.
only in this year, maybe in the future year. The source of funding is my debt, suppose.
Mhm.
Should I need to take all the year debts, or should I need to deduct the current year debt, what exists in my balance sheet on the date of the valuation? Okay. So
Yeah.
the question is, we will always be deducting as on date on the balance sheet what the debt that exists, as on date what the cash that exists in the balance sheet, maybe in the future, because that is the future. I can't say like what is going to be. And so I will look into what is the present scenario is, what is the source of funding as on date, and I will look into what is based on the current funding level, how the company is able to roll out the things together. Okay.
Okay.
Because maybe like 3 years down the line, I may go for another like a big enormous funding level. Okay.
Right.
So suppose take example like Baizu has acquired Akash, and very good talk that has happened with one of the person from this company called Great Learning, because we are also the valuer of this company, and we have valued this company 3-4 times. And in the last round, before this Baizu acquisition, we are valued at $100 million. Baizu has like making acquisition at $600 million. So how this 6 times what a valuer you've been valuing at for a private limited company, this thing being there, and now 6 times. What is the justification behind that? Is the valuer being wrong? Is the So this being the question that I asked to the CFO of the company, that sir, please tell me like how you able to convince Baizu for this particular thing like 600 million, because your past record, past valuation, everything was not speaking anyway to that level. Okay. He said that basically Baizu was not being more interested in just like looking into my past record and all these things, because they're being more interested in what is the future roadmap is. Because the type of the scalability, the type of the scale, what Great Learning can look at by itself may be very different from what Baizu is able to look at or foresee it. So because Baizu is in an acquisition spree and they want to acquire like every segment of the education industry. Okay. So and this is something which is on a high grade that Great Learning is providing, like high grade learning models. So they want to acquire it. When they are going it with $600 million funding for acquisition, it is not like they paying a very high. They are looking at 6,000 million. That is the value that you are looking at, that they will able to create it. Great Learning itself can't create that thing, but they can create that thing. And similar is the case like White Hat Junior. What was White Hat Junior? That just being a startup by Karan Bajaj, and that's how he played the things together in a better way. And he knows like Baizu may be the person who may be acquiring it. Okay, so very high premium. That the deal has happened, and that being all cash deal. That is not something like an equity settlement. That being the cash deal. So is the valuer is doing wrong, or it is not the valuer doing wrong? It is the investor sentiment. We always try to focus upon like the investor sentiment, what he has in mind. If I can suppose make somebody do very well, then I know what is the value that able to create out of that. Okay. So suppose take a very simple example. Suppose if I go and find somebody in an orphanage and take one child and say that I will make his life good. Okay. And I start like training him, I providing him all the help, education, everything. And then I will say that I will prove to this world that this is. So on his organic way, he can't able to do that. But it is the support that you created, because you can foresee the things, what he or any orphanage, they are not looking at those things, right? So it all depends upon the investor, what he because like nobody is a fool to pay a high premium, because he knows that a bigger fool is always being there. That bigger fool theory. Even the next investor will come and they will infuse money at a much higher premium. So that is how the word goes. So when we talk on the realistic side, our realistic side is very much different from what is the academic side is. Okay, then everything get failed. That I have never thought of. If you try to like creating a patch between $100 million and $600 million, you'll never be able to. Like you say that sir, projection to yahi tha. Kya projection change ho gaya tha kya? Kehta nahi. He said that no, the same projection, Maneesh, what I have provided to you, that the same projection being provided to Baiju. No, not even a single dot change, but 600 million value that is being proposed. So that is how the industry works. And as a valuer, suppose now Baiju, we are not the valuer for Baiju. So Baiju, another valuer may be doing it. Then he will do the valuation backward calculation of $600 million and said, as per DCF, the valuation is $600 million. So this is how it works. But
exactly, Mr. Manish, I was going to say the same thing. Last evening when I was listening to Damodaran, he was saying that these chartered accountants, there was a question from ICM Institute that how to make ICMAs as best valuers. So he said, you will be very disappointed to listen what I am going to say. This is not your cup of tea, because you are the ones who work on actuals, historic data, on within the framework of IFRS, AS, this and that, and you cannot think of future. And what is future? You have to discount the future, and future is something which comes the way you are explaining from the data or from the perspective of a person who takes the person from the orphanage and develops him, and he knows his capabilities also, that how I can develop it and how can I realize value out of it, the way Baiju did with Akash, and the way they are going to acquire this IAS Academy to train those kind of people. So this is where the difference is, and I fully agree with you on that. Thank you. The 600 million question when you ask about Baiju to with a valuation of 6 billion plus.
Come again, sir?
The Baiju raised this money for Akash with a valuation of 6 billion plus, and it was based on these kind of valuations only. Futuristic approach.
Of course, futuristic approach, because one thing I would say, I being a soft bank, suppose I will create a new industry. I will try, suppose there being a cloud kitchen companies.
Exactly.
There's nothing like earlier cloud
Zomato
kitchen.
Also he was discussing.
So there being a cloud kitchen company, they will start infusing money and they will make one company a market leader. And this company will become a unicorn. So it is the investor game, what is happening. And because they know how to create a star. Wherever I will go, I will place the money and the money will play the game. It will dance on the tune, and then accordingly, the unicorn will be created. So most of the time that being created by the investor, it is the investor game. It is not like the promoter game, because promoter.
Use the camera.
Carry on. I think Suresh is muted.
Not able to hear. Somebody is raising a question. Another point I would say that try to work one thing, like we look at the valuation private equity round, the last private equity round that happened in any company, and when it goes for an IPO, and then you look at what is the value that being there. Okay, you will see that there being a drastic difference between the two valuations, the last round of the private equity and the IPO, because it is the game which the investor is playing. Investor is saying, I have made investment 5 years earlier, I need a 10x of return on my investment. Okay. Everything then being worked according to that. Like suppose my per share value is, suppose 5 lakh rupees per share value is. I can't go to the IPO market at 5 lakh rupees per share. What I will do, make a split of my shares, and then my per share value will come down. And that is how, because if you look at the IPO prices, it is based on how the retailers will look at, how the QIP will look at. So they say that 500 per share value, 800 per share value, or maybe 1000. It does not go like 5,000 rupees per share value, because they know that it being a, so it being like, and when the any share comes, IPO comes, then what is happening? We look at general public, we look at per share value. Okay, 500 चलो लगा देते हैं. Zomato नाम बहुत सुना हुआ है. And you know, like what has happened to Zomato? There is so much of like positive vibes among the public that this is, the Zomato will work very well. And you will see like what has happened. It is not something like the price at which is open and now what the price that is being running. That is something that not something great that has happened. But of course, the promoter, it being good to the promoter that they have got the money what being required. The investor who has made money, he has taken an exit, and all those things have happened. But if you say that retail investors, they're not able to make the money in these IPOs. If you look into this again, XRO tiles, again that's been rolling at the same price. If you look into another like this one, this KFC franchisee, which Devyani International. Again, the same price at which 124 rupees is the price at which is there in the market. So they are not able to, because the question is everybody is in a hurry. I want to go for an IPO. There, and the SEBI is like sitting like, what is happening? Everybody want to go with an IPO. This company, Wow Momo, 600 million is the valuation now they are being looking at. So the question is, I've been not saying that it is right, wrong, whatsoever. But the question is, I was just thinking, suppose if I ask Zomato guy, I make an order to Zomato and I take one samosa from Chaos and it will come to my home. Of course, they will take the delivery charge and all these things, but still on a per unit basis, is that something that will create a value or not? So that is a big question mark for these companies are. I'm not against it, but the question is, when you look at the per unit costing at per unit costing level, the things may not seem justified. They're being one hotel chain, and that's a big hotel chain. I don't take the name, and this hotel chain was doing wonders, and so much of the infusion of money is taking place, and now the company is actually being in a fix. Like,
are you talking about Oyo?
Not talking about Oyo. Oyo also story is very pretty bad, and but in the public forum I don't want to comment on any company specific. But yes, of course, there being things that being there that even you talk about Oyo, Ritesh Agrawal himself gone and placed his shares in order to get the funding, because they being the need of the funding at this particular hour is okay. So when you borrow the money at a very high cost, then it will be very difficult to justify your business model in a longer run, and the companies burn out at a later point of time. Everybody is now talking about Baizu. I don't know whether this Baizu will actually able to deliver value in the time to come or not. I personally suppose White Hat Junior is the running the show for the small kids, coding classes and all. Whether that is actually being relevant, and whether people are I also enroll my child, then I felt that this is not the need for my small kid. And then so whether those things really workable or not, something created on a filmy way, fancy way, I'm not commenting on this, but the question is, time will come, time will say what is the real picture behind it, whether it will bust, or because like making acquisition at such high cost, what is going to be the future of the company. Yes, of course, it will go to IPO, hit the IPO market, take the money from the public, but whether again in a longer run, will there be any sweetness that will be left after the IPO or not? I don't know whether it will be there or not. So, like there being a company called Educom, and that being the first company into the education space, that being a listed one. And like what has happened to the Educom. So
in the IBC.
Yeah, in the IBC. So these are the things that we need to look at. But everybody, every investor, everybody wishes to be the part and parcel of the train which being running fast, and the bigger fool theory plays the game. If I invest at 5 lakh rupees per share, it will go to 10 lakh rupees per share. I will win 5 lakh rupees, and that is how it goes. There being a company called India Mart. India Mart IPO came at the price of 1,300 something. The price in the market reached to the level of 9,000, and then it has come down to 7,000. The company owner himself does not know like how this price is running. There's been Corona. The employees are not coming to the office. Not much of the business is also there, but still the price is shooting like anything. So if you look to the stock market will provide you a very different picture. The stock market is galloping like anything, right?
And that is why this mad rush for IPOs also.
Yes,
to encash that.
When the market is good, everybody wishes to, because they will get a high multiple, and that is they are just thinking that let me hit the IPO, and that is what is happening. Yeah, there being a company Paytm that is again looking for IPO, and that may be looking for IPO into the Nasdaq and something like this. And there being one company like Renew Power, which is our client company, which has got listed into the Nasdaq, right? So now they are being the spec model as well. Like they are being a company which been incorporated in the US, and that being a newly incorporated company, then there's being the reverse acquisition, and that is how they get it listed, and all these things are there. So there are a lot of things that are happening. We have never in our life seen a company getting listed into the IPO BSC, which has a negative EBITDA. And you look into Zomato, negative EBITDA, profitability, and that got listed. So
exactly,
things are changing, but whether the survival is going to be there or not, I don't know. I can't comment on that.
$1 million question.
So this is all that what is there I want to place before all of you, and so I will better will be you raise any questions you have. Even I can answer, or if I can't, then somebody from your side can answer. And you all being knowledgeable, all being like a source of knowledge, and the word looks at all of you to like deliver, because and this is a time when most challenging time we are sitting with, because everybody raised a number of questions. Sir, because of Corona pandemic, what should be the discount? Uski wajah se projection mein kya change aa jayega? And number of things, and we need to deliberate on all those stuffs, right? You do the valuation, then the auditor will give a call that explain me, give me this thing and that thing. The world is changing fast. They are now the auditor also being asking for looking into like certain complex scenarios. Like they are not like just looking at the equity value. Suppose they are being a CCD or they being the CCPS, and they have the terms which being the terms being such that it can happen at any point of time. It can get converted at any point of time. You now need to apply the binomial, and there will be a whole debate over that. So the word is becoming more difficult, and when the word becomes difficult, then actually the knowledge plays a game. There being few of the people I really feel bad about, like there being few people who become registered valuer, and they are not doing justice to the work that being assigned to them. Like they are doing the valuation at 5,000, 10,000 rupees. And I don't know, like what is like, why you are making this good thing so bad. And it is not some, if you don't know, please don't do it.
If you know, then start doing it or start learning first. Like passing the examination is not the only factor to say that you know the valuation. Anybody X, Y, and Z can appear into 5-7 times and pass the examination. But it is not that you know now the valuation, because I personally feel myself that every day it is new for me. And even Abraham ji is sitting and he will agree with me that it is not like in one particular day I would say that I know everything. And being such a challenging thing, I may be totally wrong. Even Damodran was saying that I was valuing Twitter and I was totally gone wrong. I've never thought the value should be so much. So we need to learn every day more, understand the thing better. And learning is not just learning the financial number side, learning about the industry side, how the industry is working, what are the key factors, what are the drivers behind it, what is the cash flow, how this cash flow being generated, and what are the factors that being working along with this particular industry. So all those things, and what are the government guidelines are. Suppose if somebody comes and says, please sir, value a company which is making like suppose this Rajnigandha or any tobacco product or anything like that, there's always being a chance that tomorrow the government may come and say that no, this is totally banned. So certain risk factors I need to look at, certain high level risks also need to assign while doing the valuation for this sort of segments, which are high risk segments, right? So this is there from my side. Any questions you wish to? Actually, there being certain poll questions that being there. Let me.
Yeah. Shall I run the
Before
poll?
that, I think Shilpa, you wanted to do a few announcements also.
Yeah. Can you stop sharing just for one sec?
Sure.
Basically, we would like to make one announcement regarding the request for volunteers to get involved in the Bangalore Valuers Association activities. Few of the responsibilities which we would like to ask for volunteers is with respect to education committee. Education committee, just the Google form will be sent out to you now, which will expect you to express your interest to contribute to the activities of Bangalore Valuers Association. No association can run for a long time. It is not a one-man job or a two-man job. All of us, I request, please participate as a volunteer so that together we grow. Once we share the knowledge with veteran speakers like Maneesh and many other speakers, what we usually invite, together we share the knowledge and together we grow. Okay. And the profession, we as a professional, as a valuer will get more respect if the valuers as such, as a whole community get elevated and gain more knowledge. In pursuit of these efforts, one of the position or one of the volunteering aspect is education committee. Education committee will focus on the number of, the topics which can be deliberated among us, like selection of topics and selection of the speakers. And there is one more, volunteering requirement for technology committee. We would like to increase, how our website is functioning, how to elevate any technology related. It can be LinkedIn, or it can be, anything as such, like website related, all of you can get a personalized email or whatever activities, this committee will deliberate. And for that, we need people, we need volunteers, not for namesake, but who are willing to, share some of their time as and when it is required, and then have more ideas, implement those ideas, and see, how we can bring it so that all of us only will benefit. And membership committee, like how we can increase the members, or how together we can have, say, we can also think of, one of the members was sharing with me, we can have a subcommittee, one of the suggestion that which will focus on freshers, like topics which of a fresher would be interested, so that, as Mr. Maneesh is suggesting, they may not know, for whatever reasons best known to them, they may not be aware of how to do valuation. So let us make an effort so that, if we can have a subcommittee, if you all can volunteer and support us to take up any such activities. And one of the other activities is research committee, wherein, this committee will have a particular, whatever Mr. Maneesh has suggested, that even I have doubt this, like that each one of us, yes, we have a doubt, but the research committee can contribute by doing research, and they can come out with whatever research findings, and we can have a session on that research finding. And secretary and treasurer are little bit admin related work. And any other suggestions you have also, please feel free to tell us. We want to try to revamp all of this so that, it can be more beneficial to each one of us. I request Mr. Ravindra to post this, request in the chat as well as in the BVA members group.
Yeah, I'll do that right now.
Yeah. And during the end of the session, we will be sending a Google link for feedback in this chat as well as in the BVA members. When would you like, Mr. Maneesh, for the poll to run? Shall we do it now?
Yes, sure.
Sure. And let me just ask you a question also then, Manish. Normally we do either FCFF or FCFE. So I've understood from what you're saying that let's do an FCFF. And in that last example where you said 7.5 crores is the amount of fixed assets which would be there. So that for me, I think ties into FCFF, subject to only one correction, which is the 7.5 crores, right? Meaning that between the pre-money and the post-money, you just add the 7.5 crores, which otherwise would be there in the FCFF as a negative. Correct. I think that's my understanding of what you said.
Right.
Would I be right there?
You are right, sir. 100% you are right. There's no doubt.
Okay.
While the poll is on, people can unmute themselves and ask their questions. And once the poll is ended, Mr. Manish, you can tell the answer for the right answer for that poll question.
Mr. Manish, this is regarding the scorecard. The weightages that you assign, is it completely the prerogative of the valuer to decide what weightage to each parameter, or is there any guideline on that?
There's no guideline that exists. These are all the new things, and it is like how you understand about the company. And that's what I said, that when I say probability factors, survival 50%, extremes 25. It is all that the way you feel about. Okay. And so there's no hard and fast rule or guidance that talks about that this should be the way that need to be done. Okay. Maybe in the time to come because otherwise this being something in which guidance note cannot be even created. The question is because every industry and every company differs, and you need to understand what is the risk probability factor need to be. Okay. So it is like you need to do it. You have to apply your mind and say that what should be the real percentage is.
Manish, this is Nataraj here. My question is, we have different methods. So for a particular valuation, do we have to test different methods, or we can stick on to one method? How do we go about it?
That depend upon the industry and the company that you are valuing. Suppose if I being valuing, suppose Paytm, and Paytm is also a client company. Suppose you are valuing Paytm, I can't apply net asset value. I can't apply EBITDA multiple, sales or EBITDA multiple or the PAT multiple because they are negative. So I can always look into like what is the future projection and the discounted free cash flow. That may be one. If there is a company which being heavy asset-based company, that may be suppose a hotel, and then of course the net asset value also plays a very critical role in that. So it all depends upon the type of the industry. So it is not like it is the right way of doing, like doing the valuation of all the categories and then assigning the weight, like net asset value this much weight and this much, and finding the average. That is not a right way of doing it. We should choose the model based on the industry and the company. Suppose there being an IT company, there's nothing like much of the like the land, building, plant and machinery, everything like there being only like the desktop, the laptops and the people. So the question that will be there is I will need to look more into the income approach rather than any other approach in that balance. So the first question, please come to the first question answer. I believe like 74%.
Yeah. So the DCF, sorry. I will finish this and then show the first.
No problem. So I will suggest something like on the first question that whether the DCF captures the intangible or tangible, or 74% people I believe have given the right answers. And so DCF, when you say DCF is the overall value of the company, it captures the tangible, intangible, everything. At times there may be a debate, like even after doing the DCF, the promoter is saying, like, sir, I've been running this company from the last 10 years. Where is my goodwill? You have not considered my goodwill.
That may be the question point that may come at times. Okay, the question is everything what being there, that what you have created being the part and parcel of your DCF methodology, because it got captured in your cash flows. Because you have that particular goodwill, because of that you're able to create that much of the cash flow. Because you're able to command the price of this much, because you have the goodwill factor. Suppose Infosys is there, the software what the Infosys developed, because of its repute, because of its knowledge base they have, that is the reason that they're able to command that particular price. And when the price comes, then the cash flow is based on that particular price. So that being the intangible also being captured and part and parcel of the DCF. Whenever we go with the intangible valuation, we generally do it when we go for the purchase price allocation, and where we assign the weight to the intangibles, and we say that these are the intangibles. Again, there's one question point that somebody says that please assign weight to assign value to my workforce. Workforce, yes, it can be valued, but the question is like you can't book in your books of account. So it is only like you can book like certain intangibles. It may be the patent, trademark, industrial design, or copyright. These are the certain which you can book at. But if you say workforce accounting can be done from the perspective to look at, but that cannot be booked in your books of account. Any intangibles which being self-created again cannot be booked in the books of account. It can only be what from an inorganic way, what you are acquiring can only be booked. Okay. So this goal number 2, what is the best method to value a startup? Net asset value, comparable company 15%, saying DCF methodology 18%, 2-stage DCF methodology now 68%. That's a good number. That is the correct number. Somebody would say only DCF methodology 18%. Yes, because most of people are doing it. So I would not say there's anything right or wrong, but the question is like 2-stage model is always a better model to given for valuing the startup. Even it may go to the 3-stage as well. Somebody, if they're being the answer, maybe 3-stage model, it may go to the 3-stage as well. Okay, so it depends. It being more on like how you perceive the thing.
Hi Manish. Manish, I have a question with regards to the 2-stage model. So how many years of projections would be required for this 2-stage model?
Actually speaking, if you talk about real valuation sense, then the projection need to be till the time when the company is able to reach the maturity phase. Okay, and so suppose there being a company which being into the toll business or making some dam, bridges, it will take at least like 7-8 years. Narmada Dam maybe, suppose 10 years it may be. And suppose if I just been provided with 5-year projection, my value will be coming negative because everything is negative in the initial 5 years. So it all depends upon what sort of industry we are valuing, and based on that, the number of years needed to be decided. And but I would again say, and that is the reason, like if suppose the company has provided only 5-year projection, and I believe that the growth is not being harnessed in these 5 years, then I apply the H model, and that is how we able to sync and say that at least we look into the 9 years. 5 years plus 4 years or another 5 year, the high growth model stage, and then we say that this is how we looked at. Okay.
Okay, sure. Thank you.
Scorecard methodology is what? A qualitative methodology, qualitative methodology, both A and B. Now they're being 41 and 59%, that being something very close now. A scorecard methodology is what? Qualitative methodology in both A and B, quantitative and methodology. Though frankly speaking, if I say answer to this question in literal sense, then the answer will be, I would say, qualitative methodology. Okay, but somebody while thinking about, like, there may be certain quantitative factors also which plays a role in the scorecard, but a scorecard is majorly like on a qualitative side that we look at, because we are placing all those features and parameters and placing certain numbers to that. So I would say qualitative is a better answer to this.
I had a question on this. When we are say basing our method of valuation on scorecard, would it be okay to just rely on whatever comes on scorecard, because it is very qualitative in nature and very judgmental in terms of the valuer, right? So
Usually, this is scorecard. Scorecard is majorly being used by people who've been sitting in the fund houses, or they've been sitting in the family business offices, where this scorecard is majorly being used. Or even if you go to, suppose you go to, like suppose SBI Bank, you go and some project funding or that sort, they have their own scorecard to look at. Okay, so scorecard is something like which this people at the time of making investment need to look at, as well as when somebody asks you, like you do this valuation, a real valuation, then you look at this scorecard. And yes, it is a qualitative, and there may be a differ of opinion if somebody is maybe assigning higher weightage to something based on the knowledge that a person possesses, based on the experience he possesses. Suppose somebody comes to me and says that I being starting something that is for the EV, electronic vehicle companies. And so I being very optimistic about this particular industry is, that is what is going to be the future of this industry is. So I may assign a higher weightage. Suppose it comes to Mr. Ravindra, and Ravindra thinks that no, I may be not bullish in that, I may be bullish in something else. So it is the prerogative of the valuer, as well as it may be the call, because if two people are doing the valuation of the same thing, they cannot be the same numbers that may come. It's all based upon the assumption that you are taking and placing the things together. Okay.
So along with scorecard, should we also look at some quantitative method also?
Of course, yes. I would say that whatsoever the value you derive, suppose under the Chicago method, you derive the value, because the value being derived in the Chicago method. The scorecard is just the qualitative factor to build the scorecard. Suppose my value under the scorecard is coming, suppose 0.7. Out of 1, it is coming 0.7. Then I would say that the value what I have found, suppose 100 is the value, 100 CR is the value I derive. I would say 100 CR into 0.7. That is the value of the company I look at. Okay, it all depends upon the what sort of qualitative factor you built in your scorecard, and that scorecard will be helping you in creating the difference between the companies which have certain qualitative factors and which have less qualitative factors. Okay,
Manish, when we are using a discount rate, I think Mr. Damodaran said don't spend time on discount rate and focus on the top line. So let's discuss from both sides. This particular discount rate concept is more for a stable, matured companies where you take a discount rate today, which is what we call it a reinvesting rate over a period of time. But typically in a startup where the risk of achieving numbers or the risk of capital itself is different year on year until there is a stability. So yes, should we try to look at different risk capital values instead of one risk discount rate for all the years?
I got your point. A very good question that you raised. And because like in a startup, every year the thing goes very differently when you look into the capital structure side. Okay, the debt equity changes, the equity basically changing every year. And the question is like, if I just take my initial year cost of equity, then I may be doing wrong to that. Okay, you can go and look into like every year discounting and based on the capital structure. But the question is like, when you say like a startup, try to understand there's nothing like a debt. Mostly we will looking at the equity and equity funded, and because nobody is going to provide you a debt. Okay, no bank is going to provide you debt to a startup. So my cost of equity, my back is my cost of equity only. Okay, and when I say cost of equity, I being for a startup, I am not being just following the CAPM model and saying that 15% is the cost of equity. It may go for a startup, it may go my cost of equity to the level of 30%, it may go even to 35%, looking into what stage you are. And suppose I being a startup and just saying that I have certain idea of doing something, I being presently in my job, I will do this thing. So you just have the idea, you're not just initiated the thing. And suppose if the idea is good and I liked it, and suppose I'm willing to make certain investment, then I may say that at least, yeah, there being so much of risk involvement is there. I need at least 40% return. It may be the return, or it may be like, I will take a higher percentage of the stake in your company. You provide me 50% stake, okay? And you take my money. Then, so this is a different way of to look at the thing. And when you say startup applying the cost of equity, I'm not applying cost of equity as per CAPM. I've been already applying it based upon what is the risk I perceive for this company. So I may apply 25%, 30%, 35%, whatsoever the perceived risk I feel. There may be a question point that comes to you, sir, additional risk premium 7% ही क्यों लिया आपने, 10% क्यों लिया, why not 12%, why not 8%? Please don't look at from the perspective of just number of an additional risk premium. Try to look at from the overall perspective. What is going to be my cost of equity if I add 10%? What is going to be my cost of equity if I add 7%? So, and this cost of equity on an overall basis is a return expectation of the investor, basically. So we need to look from that perspective. Okay.
Yeah, sorry, my question was slightly different. Okay, I was not saying. Can I ask question, Silpa, or should I stop it?
One second, let him answer the poll question. Then I will run the 5th poll. Then you can continue.
Sure.
Like 77% people have said it's scenario based, then it is how the people perceive and look at it. It should be scenario based valuation. Yes.
You can continue with the next sub point while I launch the 5th poll.
Am I audible?
Yeah, you are audible.
Yeah, just wanted to ask you about why it is not sensitivity. But basically, it is a sensitivity analysis, correct?
Sensitivity analysis is basically like we are playing with certain, like taking certain thing fixed and certain variable. I've been playing with my cost of equity, suppose, and making it 1% up, 1% down. That is the sensitivity based thing. That how sensitive the things are. If I change 1% up, 1% down, what is going to be the cases? Okay. And but in this Chicago methodology is basically talking about scenario. It is built upon the scenario based only. So scenario is not something which is sensitivity only. Sensitivity is something which what are the factors we have applied, and in that factor I may have done some wrong. So I would say that suppose my cost of equity is suppose 15%. If I take it 14%, what is going to be? If I take it 16%, what is going to be? So sensitivity analysis help us in providing a viewpoint on what is going to be the range that will happen when I change these parameters. Okay. But scenario based analysis, basically Chicago based method, is based on the scenario, like what is the probability factor basically.
Also, one more question was there, wherein you were asking, the question was that how many years we have to take for 2-stage growth. So in that case, normally startups are very, their revenues are not really assured. So giving 5 years or 10 years of projections is something questionable, and they will be asking us that why you need this much. So in that case, what to do?
That is the answer to the basically your question being derived from the answer what I provided. This question was, the promoter basically will say that I can't look into another 10 years. I can maximum look into 3 years or 4 years. Okay, that is what is the, so if you are being provided with just 4 years, and that is a hyperbolic growth in that particular years, 4-year period, then what you are saying that I will be not asking from the management for another forward years. I will be applying the H model and say that one Gordon model I will apply at this high growth, and then another Gordon model apply at the terminal, at the end level. So that is how we will look at all those things. Okay. So that will be, this H model is actually helpful in taking my projections further. Instead of making entire projections, I've been applying H model and bridging the gap between the high growth and the terminal growth.
This 5th poll answer, please.
They've been like 15% have said like method to value mature companies. Why the venture capitalists will go into mature companies?
He wants to book his profits and exit.
No, anyway, but so of course, like 82% people have said that it's a venture capitalist method. Yes, of course it is. And
let's go back to the comment by Joy Jane. Earlier, Joy has mentioned in when we were talking about the venture capital method that it's more a method which is used for identifying what is the investor's value rather than a fair value of the company. So if Joy wants to comment on it further, he can. But otherwise, do you think that's a fair comment from Joy, Maneesh? What do you think?
Yes, of course it is, because venture capitalists, the way they look at and the way they feel that what is the return expectation they have and how the company will roll out. So it is basically the venture capitalist method, and this terminology being derived from this venture capitalist only.
Yeah. So if it's not a fair value, for instance, then it's very likely that you can't really rely on it to book values.
Venture capitalist method will become the fair value later on, because the question is, because things being negotiated based on that, then after the negotiation, then it will come to the registered valuer and they will say that, okay, this is the price that being decided and you do the valuation.
Actually, one suggestion which we are expecting from you is there a chance that there are well-developed valuation website, software, or anything? Of course, we will again change whatever parameters are affecting the valuation and generate a report, which you have had, which you have checked, and may not be, we will not completely rely on those outputs, but then I may not err in something, some very good brain or thought or experts have gone into that software. It's not exactly a software, web related, solutions, any particular website, which takes parameters and then gives the report as such, with whatever way you or I or best brains of valuation think and improved on that.
Very difficult to answer this question. Actually, there being like a lot of the calculators which being available. You place the numbers, you get the value. Then there being a website. I don't exactly remember this. There's a website which will help in making you the projections. You can look and browse in Google, and you can look into, like, there's a website which help you making the projections as well. Okay, but what are the underlying features of that particular Excel? I don't know. I can't comment like how they look at what are the inner things they have, and but I would again say that generally we always try to make our life simple, but once we being into this domain, the life is not simple at times, and we need to like give a lot of thought. And once you give the thought, the Excel cannot create something which is realistic in value. So we need to always like give a thought. So people say like it's being an art or a science. Valuation is basically like a craft. It's a combination of art and science. Even what Damodaran says, it's a craft. So the question is like, it all comes by the experience we possess, and the experience plays a role in looking at or perceiving like what is going to be the future value is. Okay, so I don't generally personally believe in some Excel model in which I will just play with the numbers and automatically the value comes. That is basically the more like a calculator game rather than the valuer game.
I would like to request whether any members have tried or tested any of these, new startup methods, whatever we have learned today, either to RBI, many times RBI people have actually gone through it. So anyone wants to share their experience, we'll be happy to listen. If you have tried it, did RBI come out with any sort of query, or they just accepted it and taken to record?
Well, I think that one suggestion is that if you use one of these methods, you use it as a reconciliation of values to justify the TCF.
Actually, what is happening,
use two methods. Yeah.
You are saying right, Abramji. And what is happening, like even we are doing this, what is happening, we are not placing it in the front of the report. we are making it as a part of the annexure, right? So then because the person want to see your DCF, he is not looking into going into detail, because even if, suppose if I provided a report and done the, suppose some sort of like the back solve model, or at times we need to do the back solve and all these things, by looking at just the word copy, nobody can able to look at how the numbers being derived and how these numbers actually being flown, because they don't have the Excel, because RBI or ROC does not require Excel also to be submitted. Okay, these things generally happen at the time of the assessment. Like maybe the income tax authority calls somebody and says that how it being done, then the valuer will be called, and then you need to explain that how it needs to be done. So everybody want to make the life simple, because nobody want to go to the commissioner office and explain like this is how the things being there, right? So जिसको जितना समझ में आता है हम जनरली उसको उतना समझाने की कोशिश करते हैं, राइट? तो क्वेश्चन क्या है कि देखो हम लोग अभी एक क्लोज ग्रुप में बैठे हैं, इसलिए हम ये बात कह रहे हैं, मतलब इस बात को मेरे कहीं बाहर आप नहीं वो कीजिए कि जो है ऐसा, बट द क्वेश्चन इज लाइक कि मैं उसको कितना समझाऊंगा और मेरे पास कितना टाइम है, हाउ मच टाइम आई हैव, दैट इज अ रियलिटी पिक्चर इज ना, घर भी चलाना है, दैट इज व्हाट इज देयर। तो क्वेश्चन इज लाइक कि मैं कहूँ कि नहीं मैं तो एकदम 100% ऐसे करता हूँ और इस तरीके से करूंगा, सर मैं अपने बिजनेस को कैसे चला पाऊंगा? तो प्रैक्टिकल वर्ल्ड, एकेडमिक वर्ल्ड, दोनों के बीच में थोड़ा एक ब्रिजिंग द गैप है, जिसको एक रियलिस्टिक है, जिसको हमें मानना ही पड़ेगा, ये चीजें हैं। देयर बीइंग टाइम्स, अब मैं कहूँ बहुत लोगों की नहीं मेरे को सब कुछ देखना पड़ता है, but the question is at times the valuation come to and they say that I want it tomorrow. अब सर आप कितना उसमें ब्रेन लगा लोगे? आप एक दिन में वैल्यूएशन देने में आप कितना जस्टिफिकेशन आप बिल्ड कर लोगे? आप कितनी स्टडी कर लोगे? But you don't want to lose the opportunity also, right? So question is at times, yes, the valuer, we are not like academicians कि मैं बैठ के जो है दामोदरन जी की तरह वो बात करें, बट द क्वेश्चन इज मेरे को भाई रिपोर्ट सबमिट करनी है तो सबमिट करनी है, अब वो सबमिट करनी है तो आई लुक एट ऑल द ब्रॉडर थिंग्स, बट मेरे को कहीं ना कहीं जाके कॉम्प्रोमाइज करना पड़ जा रहा है, और वो कॉम्प्रोमाइज एक रियलिटी है। नहीं तो आपके आप देखो ना कितने नंबर ऑफ आप रजिस्टर्ड वैल्यू देखो, नंबर ऑफ रजिस्टर्ड वैल्यू एवरी डे, इट्स ह्यूमंगस नाउ। I believe that what is going to be the industries like career graph क्या होने वाला है? I don't know like what is going to be the career graph. Like everybody is a valuer now, so you have to do the business as well. So and the real gain who is getting is a client, because the valuation, I personally tell you, the valuation which you used to do at 1 lakh rupees, they are saying that sir अभी तो 50,000 का quote आया हुआ है, and that is what is happening. So it's been really becoming difficult this time, and let's see what's IPBI will.
So Maneesh, one related question is that let's say that you arrive at a certain valuation of the company and say that this is the valuation. The client doesn't accept it. So I mean, have you faced any practical situation like this where you've actually just walked away from a valuation, or what's your experience like?
Yes. Not once, there are so many times, and these challenge always comes when you are doing the real valuation. This challenge will never come to those valuers who are taking 10,000 rupees and saying that okay sir 3,000 rupees चाहिए ना, मैं 3,000 की report आपको देता हूँ. So this and I would say that it's always been good to differ based on the knowledge that you possess. Okay, and at times they being a company which being into the healthcare segment, and we applied the DCF for this company, and that being a matured company, we applied the DCF. He was very adamant, and he's saying that no, you can't apply a terminal growth rate of 5%. You need to apply at least 8% terminal growth rate. I said, how? Why? He said that no, sir, because we still being into a metro cities, there's still a long gestation period. We have to go to the like rural areas and tier 2 city, tier 3 cities, and there's a long time. So 8% is a justified thing. Okay. Now, the professional charge was high at that point of time. I've been talking about 3 years back. That's something that happened. And now you as a valuer, you have to match the thing again. Okay, because he is looking at, suppose it, I can't say like 8%. I will convince and try to bring it to a 6% level. Okay, suppose 6% is I being placing, but still I believe that I don't want to give this person a value so high because terminal growth is multiplying the value. So what I have done, I made an additional risk premium on a higher side and bring the value the same what I wanted to give. Because once my report gets floated in the market, nobody can come and say, they may say on the nitty-gritties, sir, you have taken 6% and that is wrong. I will accept that, okay, maybe, but you find the value on your way. Now, if you find the value, your value will come the same. Even after taking the 5% terminal growth, it will come the same what I been saying. So there's the way of doing it, but I've been doing whatever I feel personally that this should be the value of the company. And it always been good as a value to go on a conservative side rather than going on a higher side, providing more flexibility. So conservative side will always save you. It will save our skin rather than just listening to the promoter and going according to his whims and fancies.
Great. That's very useful for valuers here in general.
Now we come to end of the session. I request Mr. Ravindranath to formally convey a vote of thanks. Mr. Ravindra, are we trying breakout rooms also?
Yeah, we can try that out, Shilpa, after the vote of thanks.
Yeah, so I request the people not to, leave the session. You can network and, talk to your fellow professional buddies, and, it's a good networking substitute to physical meeting. So please stay with us.
Yeah, Maneesh, I would like to thank you on behalf of all the members present here and on behalf of BVA. Thank you for conducting such a wonderful session. You started off by telling the role of a businessman and a valuer and how both are different. And you also reiterate again and again throughout your the program, it's just not about the Excel, and it's about the real valuation. And how promoter thinks himself right and how valuer thinks himself right, you kind of deliberated on those things. You talked about an integrated business model, really going backwards and then going futuristic. And you also mentioned it's not the management who is supposed to give the projections, unlike Damodaran, who says that we should be doing the projections and coming to a value. But also at the same time, you said Damodaran is Damodaran, which struck to my mind. Being such a senior person and only into valuation, he has all the time and we say we don't have time. Then again, you took us through the relative valuation and how to compare with the listed companies and unlisted companies and take the data out of MCA, and also all the challenges startup valuation will have, because it won't have any background and no comparable, and the future visibility is not there. And also you helped us to, in that startup valuation, that pre-revenue generation and how to value an IP and how the IP gets more of a value to the company and it has the impact on the company. Then you took us through various other methodologies, including the garden growth model. You really explained very well, deliberated on that two-stage model, the H model. And I think a lot of our members had doubts in that. And I think we are all now very clear how to use this H model in normalization of high growth and then bringing it to the terminal value growth rate. Then we had a scorecard method, and that is, giving weightage and probabilities, and also bringing in our own factors, looking into the company and doing little research on that. I think our members are now in a good position to value in these methodologies. And at the same time, we all had doubt whether we should bring forth all this in our valuation report. Then you mentioned how to do it for a businessman and how to do it for government agencies like MCA. I think, again, we are all very clear on that, how to report our valuation methodologies. Then we had a detailed deliberation on venture capital method and first Chicago method and all the scenarios of the best and worst and moderate scenarios. And how these latest valuations have taken place, how the CapEx impacts the valuation, particularly Byju's, Devyani's and all, why the value is so. And I think you gave us a very patient hearing and addressed all our concerns and really took our time to all the deliberations. I thank you very much. We have heard you for a second time and would like to hear you more again and again. And I invite you for our further programs. Keep giving us your time. Thank you so much. Shilpa, shall I create the breakout rooms?
Thank you, Maneesh. Conclude, no?
Yeah.
So thanks everyone. Thanks Shilpa. Thanks Ravindranath ji, and thanks Abraham ji, and thanks everybody for having a patience listening, as well as like everybody contributed to. I personally like this. Like people have raised good questions, and that is the core fulcrum. Like why we are all here, and it is not like I being the speaker, but I learned so many things, like how the person feel, what is the viewpoint, whether I being floating something, the people will accept it or not. So, and this being really being, I being really speaking, I being first time nervous to take this session, because this is something that so many debate can come, because everything on more on a qualitative aspect, and because numbers में सब मान जाते हैं, but theory में जो है हर आदमी का अपना point होता है. So that is what it is. So I'm taking a leave from here. Thank you, everyone.
If you have little more time, you can network also, by staying in the breakout room.
Yeah, we'll be having a 10 minutes breakout.
Actually, I tell you, like I have a 2 months old baby, my second son. So he is having some problem, stomach ache problem. So I have to take him to a doctor today. Okay.
It's fine. Thanks for making time, for giving this session to us.
Thank you.
I request the participants to volunteer for management committee position as well as committees.
Sir, you're in a room, Ganesh Ramani, sir? Or you're still in an open room? I don't know.